Double entry system. Accounts are shaped like a T. T accounts are called ledger accounts. The T has a left side and a right side. The left side of the T is called debit, and the right side is called credit. The name of the account is written at the top of the T. The exchange of goods, services, or money between two parties are recorded in T accounts. These business activities are called transactions. Each transaction affects at least two T accounts. One is a debit entry, one is a credit entry. T accounts fall under the headings A, L, I, C, E. A. Assets, own. L. Liabilities, O. I. Income, earn. C. Capital, invest. E. Expenses, spend. Land, own. Bank loan, O. Cash sales, earn. Assets minus liabilities, invest. Cash purchases, spend. Buildings, own. Mortgage, O. Credit sales, earn. Cash at start, invest. Credit purchases, spend. Motor vehicle, own. Car loan, O. Revenue, earn. Personal savings, invest. Discount allowed, spend. Furniture, own. Hire purchase, O. Earnings, earn. Partners' money, invest. Carriage inwards, spend. Fixtures and fittings, own. Debenture loan, O. Benefits, earn. Owner's investment, invest. Carriage outwards, spend. Prepaid expense, own. Prepaid revenue, O. Proceeds, earn. Contribution by owner, invest. Returns inwards, spend. Stock, own. Accrued expense, O. Yield, earn. Cash out of pocket, invest. Insurance, spend. Receivables, own. Payables, O. Takings, earn. Share capital, invest. Rent, spend. Debtors, own. Creditors, O. Discount received, earn. Equity, invest. Utilities, spend. Cash at bank, own. Bank overdraft, O. Returns outwards, earn. Cash for personal use, invest. Salaries, spend. Cash in hand, own. Paid dividends, O. Bad debts recovered, earn. Drawings, invest. Bad debts, spend. Assets and expenses have debit balances when they increase. When cash comes into the business, it means the cash account increases and the T account is debited. When goods for resale comes into the business, it means the purchases account increases and the T account is debited. Assets and expenses have credit balances when they decrease. When cash goes out of the business, it means the cash account decreases and the T account is credited. When purchased goods go back to the supplier, it means the purchaser's account decreases. Returns outwards account is used to decrease the purchaser's account and the T account is credited. Liabilities, income, and capital have credit balances when they increase. When cash is borrowed, the loan account increases and the T account is credited. When goods are sold to customers, the sales account increases and the T account is credited. When the owner invests money, the capital account increases and the T account is credited. Liabilities, income, and capital have debit balances when they decrease. When borrowed money is paid back, the loan account decreases and the T account is debited. When customers bring back goods, the sales account decreases. Returns inwards account decreases the sales account and the T account is debited. When the owner withdraws money from the business for personal use, the capital account decreases. Drawings account decreases the capital account and the T account is debited. Debit, credit, left side, right side, in, out, have, don't have, receive, give. Here are examples. Transaction 1. Owner starts a business with cash from his savings. Recording entry 1. Cash comes into the business. The business has cash. The business receives cash from owner. Cash owned is an asset and it increases. T account cash is debited. Debit entry is on the left side of the T account. Recording entry 2. Cash comes out of the owner's savings. Owner does not have the cash anymore. Owner gives the business cash. Owner's investment is capital and it increases. T account capital is credited. Credit entry is on the right side of the T account. Transaction 2. The business borrows cash from the bank. Recording entry 1. Cash comes into the business. Business has cash. Business receives cash from the bank. Cash owned is an asset and it increases. T account cash is debited. Debit entry is on the left side of the T account. Recording entry 2. Cash comes out of the bank to lend the business. Bank doesn't have the cash anymore. Bank gives the business cash for a period. Loan owed is a liability and it increases. T account bank loan is credited. Credit entry is on the right side of the T account. Transaction 3. The business buys goods for resale using cash. Recording entry 1. Goods come into the business. The business has goods to sell. The business receives goods from a supplier. Spending on goods is an expense and it increases. T account purchases is debited. Debit entry is on the left side of the T account. Recording entry 2. Cash goes out of the business to buy goods. Business doesn't have the cash anymore. Business gives the supplier cash. Cash owned is an asset and it decreases. T account cash is credited. Credit entry is on the right side of the T account. Transaction 4. The business sells goods and receives a check. Recording entry 1. Check comes into the business. The business has a check to deposit in the bank. The business receives check from a customer. Bank account is owned. It is an asset and increases. T account bank is debited. Debit entry is on the left side of the T account. Recording entry 2. Goods for resale go out of the business. Business doesn't have the goods to sell anymore. Business gives the goods to a customer. Sold goods earn an income and it increases. T account sales is credited. Credit entry is on the right side of the T account. Transaction 5. The business sells goods to T-Mart Limited on credit. Recording entry 1. Cash to come into business is owed by customer. Business has an invoice stating the accrual or owing. Business may receive the cash in future. Debtor account is owned. It is an asset and increases. T account debtor T-Mart Limited is debited. Debit entry is on the left side of the T account. Recording entry 2. Goods for resale go out of the business. Business doesn't have the goods to sell anymore. Business gives the goods to a customer. Goods sold earn an income and it increases. T account sales is credited. Credit entry is on the right side of the T account. Now test yourself. Transaction 1. Owner starts a business with cash from his savings. Debit cash, credit capital. Transaction 2. The business borrows cash from the bank. Debit cash, credit bank loan. Transaction 3. The business buys goods for resale using cash. Debit purchases, credit cash. Transaction 4. The business sells goods and receives a check. Debit bank, credit sales. Transaction 5. The business sells goods to T-Mart Limited on credit. Debit debtor T-Mart Limited credit sales. Transaction 6. The business buys equipment using cash. Debit equipment, credit cash. Transaction 7. The business buys goods for resale on credit from Study Zone Institute Limited. Debit purchases, credit, creditor Study Zone Institute Limited. Transaction 8. The business pays cash for transport of goods for resale. Debit carriage inwards, credit cash. Transaction 9. Customer brings back goods to the business for cash. Debit returns inwards, credit cash. Transaction 10. Bought van on credit from Best Motors Limited. Debit motor vehicle, credit accounts payable, Best Motors Limited. Transaction 11. Paid cash in full to a supplier for goods bought on credit last week. Debit creditor, credit cash. Transaction 12. Paid light bill using cash. Debit utility light, credit cash. Transaction 13. Paid cash in advance for next month's rent. Debit prepaid expense, rent, credit cash. Transaction 14. Business owes the phone company for services provided. Debit utility phone, credit accrued expense phone. Transaction 15. Business sends goods for resale back to the supplier for cash refund. Debit cash, credit returns outwards. Transaction 16. Customer pays cash in advance for goods not yet in stock. Debit cash, credit prepaid revenue.